and gentlemen, welcome to Reference Point. I'm your host, Dave Cookerhook. We're at the beginning of 2010, and this evening and in our next show, a week from now, we're going to be talking about something that's going to be, I believe, very important to our viewing audience. You know, we've had a lot of angst in the last year. It was a kind of a tough year economically, and we're still feeling the effects of that. And once before in Reference Point, we talked about the problem of loan modification for folks who have mortgages and are having some issues with appreciation of home values, et cetera, et cetera. So tonight and next week, we're going to be talking about some real key things so we fully understand what's happening today, because the things have changed substantially in the last 6 to 8 months, and then what you can do individually to prepare yourself and to have yourself best positioned to be able to take care of this situation. With me is my guest and friend, Narvik Karamian. Narvik, pleasure to have you back on the show. Thank you for being here.
Well, thank you for having me. It's always a pleasure to be on your show.
Well, good.
Thank you.
So let's start out right and dive right into this right away. Things are not yet, the economy's still kind of flopping around in the wind a little bit, and we've got some issues as it pertains to folks who are trying to save their houses.
Right.
But the ground rules have changed a lot in
Right.
the last 6 to 8 months, haven't they?
Right. Well, one of the biggest contributing factors to the crisis we're in was the housing market. And so right from the get-go, I believe it was like August of last year when you had me on your show again, and that was during the midst of the crisis. Mm-hmm. And the government jumped straight in to try to come up with programs to prevent the crisis from getting worse. And so President Bush back then signed into law this law called Hope for Homeowners, trying to help them prevent the number of foreclosures that were due to take place.
I remember we talked about that.
Right. Well, back then when we were discussing it, everything was hypothetical because none of it had been rolled out. Uh-huh. But now we're at a point where all the lending institutions, the investors, and the banks have all experienced it on hand, and they've actually streamlined some of the processes to make it worthwhile for homeowners to actually move forward with modifications. So what we're going to cover a little bit today is the different kinds of loan modifications that have come into life, and how people can, how the public can determine what would be a best fit for them, and so that they can take advantage of it without having to pay upfront fees for loan modification companies or attorneys out there charging an arm and a leg to do what's possibly easily done for some out there.
Able to be done by themselves. Yeah. I want to definitely get into that discussion on the different programs and things like that. But I think one of the things that was interesting to me, and you and I had a conversation about this a couple days ago before the show, was the fact that the ground rules have changed dramatically. Mm-hmm. I mean, there's so much has gone on, and so many new programs have come out, and there's been so many changes. I don't know if anyone can be fully cognizant of exactly what the situation is. So if I'm a homeowner, and I'm one of those people who in the last 6 or 8 months or somewhere in 2009 got caught up in the job reduction market, I might be in a real difficult situation, but the things that I thought we knew 8 months ago seem to not necessarily be the right things now. Is that a fair statement?
No, absolutely. And I remember when the program Hope for Homeowners came out, one of the requirements was for homeowners to have to be late on their mortgages in order to be even considered for a loan modification.
I remember that. I had some friends that had that situation. They knew they were going to have a problem, and they were trying to be proactive to find a way to prevent the problem quickly or before it actually occurred, and they were told, no, well, you're not in arrears yet, and you have to be in arrears 6 months before you. But that's not the case anymore?
No, it's not, because it wasn't fair, for people who were late on their mortgages or to have to be late on their mortgages to qualify for a lower interest rate or a lower payment or even a lower principal reduction, while the citizens out there who made their payments on time would not be qualified at all. Mm-hmm. And that was more often, I guess, an oxymoron kind of a situation that was created. So when President Obama ruled out the Economic Recovery and Reinvestment Act of 2009, he actually took that into perspective. So he said that, there has to be a program for everybody out there that needs help. Mm-hmm. So we obviously have the standard citizen out there who has a home, who can refinance, there's plenty of equity, and they just move forward with their bank, which hasn't changed except for the fact that the guidelines have gotten a little stricter. Well, a little bit more than a little. They've gotten pretty tight. But then
to be able to qualify for the
exactly.
loan. But this type of an individual is someone who it would be useful for them to refinance because the interest rates are lower.
Historically lower.
Okay,
right.
Okay, good. So and they're in good position. They have equity in your home. They have their job is secure.
Exactly. Then we also have the folks who actually could not qualify. I've broken them down here in my notes, who are underwater in terms of equity in their homes, but they have very high interest rates, but yet they're not late on their mortgages. They're either tapping into their savings or doing whatever is necessary to prevent being late. And these were the folks who were not able to get any kind of a modification back then, while nowadays there's a program for them. So one of my comments out there for the viewers is you do not have to be late on your mortgage in order to qualify for some kind of a loan modification.
Kind of a modification. Now, the classification that you just talked about, where someone is pretty much upside down in the loan, is that that was impacted by the fact that housing depreciated so much?
Right.
Okay.
We had an national average was about maybe 20-25% reduction in home values.
So you go out and you buy a $500,000 house, and now it's only worth $300,000, and you keep,
Right, and yet you have the income, but there's no value for them to qualify for some kind of a loan modification.
Oh, right, yeah, I understand.
So what the government did here was they rolled out new programs where people who are up to 125% underwater in their mortgages in terms of value can qualify for a government-sponsored refinance.
Can you put that in numbers for
me?
Because I'm not sure.
So it means that if somebody has a mortgage, and I think $625,000 is a reasonable number for our area here, even if their property value is up to $500,000 now, they can qualify for a standard streamlined refinance.
Oh, okay.
While this was pretty much unheard of. So President Obama's administration attacked that group of people where they could qualify. The only reason they weren't able to do so was because of lack of equity in their homes.
Got it, okay.
Then we had folks who lost their jobs, the ones that we were talking about, and unfortunately due to the unemployment rate and the job market, they lost their jobs and they're having difficulty making their payments. It's not a sin, it happens, especially in this climate. So back in the days until the Economic Recovery and Reinvestment Act of 2009 was rolled out, you actually had to show late payments or not make your payments in order to be considered. But now the law requires you to immediately contact your lender or your servicer, let them know, and there are multiple programs for them. So if they have no income to provide, there's a program called forbearance. Okay. So what happens is they actually ask you, how many months do you think it'll take you to find a job? 3, 4, 5 months? So what they do is they freeze your payments for that many months while you find work. And then once you do, whatever you owe them is placed into the loan to just give you a breather so that you won't have to feel the hardship.
And this wasn't something that was available for people back in August?
No, it wasn't. Or if it was very discreet. So, and then we also had the ones who've lost their jobs, and there really isn't a time frame in which they'll find new work. So what happens is you contact your lender. Now you don't have to be late on your mortgage again. The banks and the servicers have actually established different departments to handle different inquiries. So if you have already had late payments, then you deal with loss mitigation or some other department that they've created. Every lender has a unique definition or name for the department. But if you don't have, or if you haven't had late payments, then you're dealt with through maybe a home retention department, some other department that deals with people who are foreseeing hardship in the very close future. And that's when President Obama's program came into play, and it wasn't really up to the discretion of the bank to decide what or how much they would drop the payments. It was actually what homeowners would qualify based on a certain percentage of their income.
So it sounds like that the current administration had put a number of things in play that really can potentially help a homeowner.
Right.
Okay. So there's a lot of moving parts in this. However, you used a couple of you used the lender and the servicer, and then there's the homeowner and whatever. So can you help me understand a little more about who the key players are in this thing, and where and how they need to be able to work together in order to, because it sounds like it's a little complicated.
There are a lot of parties involved, but I think we can break it down to a point where it'll be easily understood. Well, we have the homeowner. That's pretty clear. And we also have the bank.
Okay.
Back in the days prior to the August 2007 market meltdown or the subprime crisis, the banks were primarily the lenders behind these loans. So what they did was they issued loans and they bundled them into mortgage securities, and they sold them to different investors. These investors could be a group of attorneys, a group of physicians, or even foreign banks. Bank of China. There was a big bank in Germany called Hippo Bank, which actually went bankrupt because it had purchased a lot of these
a lot of
securities.
those subprime loans. Okay.
So therefore, the American mortgage-backed securities was spread throughout the world. And that's why when the mortgage crisis took place, it was felt throughout the world. Certain things were handled inappropriately, but what happened was now Wells Fargo or Washington Mutual, which is now Chase, Bank of America, some of the big players out there became servicers as opposed to the banks who held on to these securities, because they were actually representing the actual investors whom they had sold these mortgages to.
Okay, so the banks aren't holding the mortgages on as paper on their books anymore.
So
what you're saying.
So what they're doing is they're actually sending out the mortgage statements. They're actually the liaison between the investor and the homeowner.
Okay.
So they're actually established, because the investors don't have the means and the resources to establish that. So nowadays, most banks are considered as servicers when it comes to mortgages. Of course, the federal government, which is Fannie Mae, Freddie Mac, owns more than half of all the mortgages in the country. So that's where the investor comes in, and that's where the servicers are in play. Okay. And there are multiple services. Some of them are Bank of America, Wells Fargo, there's Aurora, there's Litton Loan Services. There's just a large variety.
Okay, so if I'm going to be in a situation, I'm a homeowner, and I'm trying to find a way to participate in one of these possibilities. I go to my bank, the servicer, right, and say, hey, can you give me a hand here? And they can say, it's up to them to say yes?
Well, it's a very good question you bring up here. It used to be, but now, as I said, some time has passed. So these processes and these procedures have become a lot more streamlined. So a lot of these investors who were really not participating in any of these home retention programs because they thought that they would be entitled to every single penny of the money that they had loaned are now discovering that's not the case due to the high number of foreclosures and a much higher number in defaults and all that. So they've actually come to the conclusion that they're better off compromising a little bit than suffering further consequences.
Okay.
So what they've done is they've actually let the servicers know of their terms and conditions in order to approve a loan modification.
Okay. The group that is we'll call it the investor. They own the paper that says this is this group of mortgages. So they will determine what for them are acceptable criteria and say, okay, we're this whatever real estate investment trust and we're okay with this, but so Mr. Bank of America or Mr. Wells Fargo Bank, these are the parameters that you have to go follow in order to. But aren't there a lot of those kind of guys out there?
There are.
So what happens at the bank level? I mean, you've got what, 4, 7, 10, 22 of these different parameters that you have to follow?
And there are as many loan modification programs out there. And that's why the success ratio of loan modifications isn't that high.
Okay.
Because there's just so many parameters. Homeowners get one shot for their loan modification. So it's critical to know the basics and the fundamentals behind loan modification so we can increase the percentage.
We're going to talk a lot about that in the next segment, I think, to give the homeowners some sense of what they have to do, what the fundamentals and basics are for them so that they can determine what they are better or what they're able to qualify for and how to proceed. And we'll get into that in the next show. But let's talk a little bit more now about this situation and scenario. So how I mean, where do you go to find out some information? I think you had mentioned that there were some government-sponsored websites that have a lot of data.
Right.
And does that data make it possible to kind of weave through this very interesting and convoluted path?
Again, these are all very good questions you're asking, because it's come a long way, the loan modification phenomenon or the concept. Nobody ever thought we would be in a position where loan modification would be required to stabilize an economy, but everybody's jumped on board pretty rapidly. But it's gone to a point where nowadays you can actually go to the website. One of the websites we have is the Making Home Affordable, makinghomeaffordable.gov, and there's actually an icon that you click on. It actually asks a couple of questions, and it tells you, based on the information you provide, whether you have a 50% or higher chance to actually get a loan, getting a loan modification.
Okay.
We didn't have that back in August. It was all a shot in the dark to see how successful it will be. So these are some of the websites, as you mentioned.
So there are a number of things that the government has put in place to provide information for people. I think we have a graphic for some of these websites that we can put up for people. And I want you folks to know that we're covering a lot of territory here, and this is a 30-minute show, so be able to digest this all is going to be difficult. But if you have questions or you want to get a printed copy of the list of websites that we're showing, or have any specific questions for Narvik regarding this topic, send us a query. Send it to info@referencepointtv.com, and we can pass that information back to you and make sure you get the answers that you're looking for. What have we got over here? How does some of the information that you've got on these graphics correlate to what we're talking about here in Narvik?
Right. This is statistics actually released from the Making Home Affordable program. This is the most, I guess, in-demand kind of loan modification out there. So when homeowners call to see if they qualify for any kind of a modification, this is the first I guess, criteria that the servicers try to undergo. If they don't qualify under the Making Home Affordable program, then they seek alternative modifications for them.
So what you're saying is they'll go to this program, and the homeowner can do that, and maybe they'll talk to the servicer or somebody to see, do I have a chance going down this particular path? So you're not committed at that point.
No.
You're not, because like you said earlier, you get one shot at it. But you have to figure out which one of these paths to go down.
Right,
okay.
And we'll cover those numbers because those are critical. But ultimately, once the first initial phone call is made to the lender tries to see if they can somehow qualify the caller under the Making Home Affordable, which is President Obama's plan.
And why is that? What's special about this plan?
Well, the thing is, behind the scenes of the Making Home Affordable program, there are a lot of incentives that the government is providing the lenders, investors who agree to do the modifications. There's a $1,500 incentive for the servicer who actually accepts or agrees to do the modification. There's a $500 incentive for the person who actually negotiates the modification. And also the government subsidizes an additional 8% of the income from their budget, which is the TARP money, to guarantee the homeowner's mortgage payment to the services. So that's why.
So they put some things in place, because I seem to recall one of the things, the last time we seriously talked about this, one of the things that was a challenge is that the banks weren't seeing how it was necessarily in their best financial interest to go down the process of doing a modification.
Right.
But that's changed somewhat, and to some degree because the government is offering incentives, financial incentives, to actually take those steps. Is that a fair statement?
Absolutely, absolutely. And also,
well, that's a good thing for the homeowner then.
Yeah, very much so. And that's why right now is a perfect time to inquire for a loan modification if there is any kind of financial hardship involved. And as we can see, as the months are going by, the percentage or the number of modifications that are being approved is going up, is increasing.
This is one of the interesting things. We see these statistics on the news and whatever about how, and this has tended to contribute to the frustration with the banking system, how some large number of modifications have been requested, and a very small percentage have actually been approved. Is there any logic behind that you can?
Well, everybody blames the other party for that. So, but from experience, having talked to a lot of lenders and also a lot of homeowners, I feel one of the reasons is, as a homeowner, they are not providing the exact documentations that is being asked for. As far as the lenders, as I said, they have created so many different departments to handle modifications. Sometimes it's passed to the wrong department. And so by the time it gets to the right department, either the documentation is missing or it's lost, and the homeowner has to fax them all over again. So a lot of things fall through the cracks. But I've seen it to a point where if everything is handled the way it should, it increases the success ratio by double.
Cool. We have less than 5 minutes in this segment of the show. I want to remind the folks out there that we're going to, in the next show that will air a week from today, we're going to be having a lot of detailed information about what you as a homeowner can do to make sure you're in the best position if you're trying to qualify for a loan modification. But I want to see if we can wrap up a little bit, maybe touch on a couple of other key things. And you mentioned something a little bit earlier that is very relevant, I think, and that is the while this is a confusing situation, there are people out there that are saying, hey, Mr. Homeowner, if you pay me $5,000 up front, then I'll help you navigate through this process. And my recollection is that used to be something that people were doing, and it was, I mean, kind of sleazy, but it was okay. But they can't do that anymore, can they?
Actually, I brought this. This is SB 94. That was passed that actually makes it officially illegal
for here in the state of California. Okay.
To charge upfront fees to.
So if somebody comes to you as a homeowner and says, "Oh, Mr. Homeowner, I know you have a problem. We're really good. We'll help you out here. Just write me this check." I mean,
that's a flag. Obviously, now it's a violation,
of the
law. But ultimately, what I would make a few recommendations is definitely check out the websites. These are all government websites. Under President Obama's administration, transparency is critical, and everything is very transparent in there, in the websites. You can actually go online and see if you qualify for a modification.
Okay.
There are levels of difficulty. If you have a good shot at it, you should initiate on your own.
So, what we've got is that there are a number of programs. The ground rules have changed in a positive way for people. So if you thought you maybe couldn't possibly get a modification 6 months ago, or back in a year ago, things have changed dramatically, and you may be able to. So there is options and possibilities for you that you didn't know about. So cool. Are there any other final comments? I'm trying to think of any key questions that I may have wanted to ask, but I think we've covered a tremendous amount of the information here. So give us like a final summary overview sort of thing, if you could.
Just like everything, at the beginning it was a test drive kind of a situation in terms of modifications. Nowadays it's all streamlined, so people have a higher chance of qualifying for loan modification, even by attempting to do it on their own. There's so much material to cover. I encourage the audience to call, to initiate emails to you if they have further questions, and we'll be more than happy to provide the answers to their questions, because I get that all the time.
Yeah. Well, it is a complex subject. So I think and that's a key thing. I'm going to remind the folks again, send us a question via email at info@referencepointtv.com. We'll get that question to the right party, whether it's one of the government agencies, whether it's to NARBIC or whatever. We'll be more than happy to supply you with the information that you need to be able to make an informed decision. It may be your property, it may be someone in your family, it may be a close friend. It doesn't matter. There's things you can do. We're talking a lot about what happens here in California, but these programs are national programs.
That's correct.
So, maybe you have a relative in Maryland that's got an issue, and some of the information is still relevant. So make sure that you don't ask because the person that you're hopeful of assisting is in California.
And the more people we help, the faster we'll stabilize our economy's home values.
So are we seeing a higher percentage of modifications getting approved?
We are noticing that because the government's tightening their grip on the lenders to expedite this process. So as I said, that also adds to the fact that it's a good opportunity now for people to attempt the modifications.
And what is the advantage and benefit for the investor to actually do this now?
Well, a smaller loss is better than a bigger loss. So there's really no benefit. It's just it minimizes the further loss they might be entitled to. And they've experienced that. If you remember when we first spoke about it, it was all discretionary.
Right.
It still is discretionary, but the investors are coming to the understanding that they are better off following what the government is doing. So
got it. So things are not turning around. I guess part of the thing was that there was a hope and expectation that the economy was going to turn around and the housing market was going to turn around on a dime. Boom.
Right.
And zip right back up to where it was 3 years ago. I think the reality that that's not happening and isn't likely to happen in the immediate future has sunk in. So therefore, they're looking at how do I make the best of a bad situation is what you're saying.
absolutely.
Okay, very cool. All right. So I guess give us a little preview of the kind of things we're going to talk about in the next segment.
I think we're going to go hands-on in terms of using examples and what are some of the numbers that homeowners need to take into consideration in terms of their income versus their expenses that actually increases their chances of getting a modification. There are a lot of no-nos, and it's good for our audience to know those ahead of time before they initiate the phone call to the lender so that it'll, as I said, it'll help them get a faster modification.
Great. Okay. So, folks, come back next week and take in that show too. We've covered a lot of territory here today to give you a feel for how the ground rules have changed. That hopefully will make it more possible for you to qualify if you need it, or a friend or family member to qualify for a loan modification if it's the situation that you're confronting. The next show, as Narvik said, we're going to get right down into some nitty-gritty and talk very specifics about what you need to know and understand for yourself and how to lay things out for yourself if you're going to manage to be successful at getting a modification. Narvik, thank you for being here today.
Sure, my pleasure.
Look forward to having on the next show that we can get these nitty-gritty details. And ladies and gentlemen, make sure you come to see us next week at Reference Point because we're going to cover some of that very important stuff, and we'll see you next time.